A hedge fund is a pooled investment fund that trades in relatively liquid assets and is able to make extensive use of more complex trading, portfolio construction and risk management techniques in an attempt to improve performance, such as short selling, leverage, and derivatives. Financial regulators generally restrict hedge fund marketing except to institutional investors, high net worth individuals and others who are considered sufficiently sophisticated. Hedge funds are regarded as alternative investments. Their ability to make more extensive use of leverage and more complex investment techniques distinguishes them from regulated investment funds available to the retail market, such as mutual funds and ETFs. They are also considered distinct from private equity funds and other similar closed-end funds, as hedge funds generally invest in relatively liquid assets and are generally open-ended, meaning that they allow investors to invest and withdraw capital periodically based on the fund's net asset value, whereas private equity funds generally invest in illiquid assets and only return capital after a number of years. However, other than a fund's regulatory status, there are no formal or fixed definitions of fund types, and so there are different views of what can constitute a hedge fund. Although hedge funds are not subject to many restrictions that apply to regulated funds, regulations were passed in the United States and Europe following the financial crisis of 2007-2008, with the intention of increasing government oversight of hedge funds and eliminating certain regulatory gaps. Although most modern hedge funds are able to employ a wide variety of financial instruments and risk management techniques, they can be very different from each other with respect to their strategies, risks, volatility and expected return profile. It is common for hedge fund investment strategies to aim to achieve a positive return on investment, regardless of whether markets are rising or falling. Although hedge funds can be considered risky investments, the expected returns of some hedge fund strategies are less volatile than those of retail funds, with high exposure to stock markets, because of the use of hedging techniques. A hedge fund typically pays its investment manager a management fee and a performance fee. Hedge funds have existed for many decades and have become increasingly popular. They have now grown to be a substantial fraction of the asset management industry, with assets totaling around $3.2 trillion as of 2018. Some hedge fund managers had several $billion of assets under management. The word hedge, meaning a line of bushes around the perimeter of a field, has long been used as a metaphor for placing limits on risk. Early hedge funds sought to hedge specific investments against general market fluctuations by shorting the market, hence the name. For nowadays, however, many different investment strategies are used, many of which do not hedge risk. 16 to 34 During the U.S. bull market of the 1920s, there were numerous private investment vehicles available to wealthy investors. Of that period, the best known today is the Graham-Newman Partnership, founded by Benjamin Graham and his longtime business partner Jerry Newman. This was cited by Warren Buffett in a 2006 letter to the Museum of American Finance as an early hedge fund, and based on other comments from Buffett, Janet Tavakoli deems Graham's investment firm the first hedge fund. The sociologist Alfred W. Jones is credited with coining the phrase hedged fund, and is credited with creating the first hedge fund structure in 1949. Jones referred to his fund as being hedged, a term then commonly used on Wall Street to describe the management of investment risk due to changes in the financial markets. In the 1970s, hedge funds specialized in a single strategy, with most fund managers following the long-short equity model. Many hedge funds closed during the recession of 1969-70 and the 1973-1974 stock market crash due to heavy losses. They received renewed attention in the late 1980s. During the 1990s, the number of hedge funds increased significantly. With the 1990s stock market rise, the aligned interest compensation structure and the promise of above high returns is likely causes. Over the next decade, hedge fund strategies expanded to include credit arbitrage, distressed debt, fixed income, quantitative and multi-strategy. U.S. institutional investors such as pension and endowment funds began allocating greater portions of their portfolios to hedge funds. During the first decade of the 21st century, hedge funds gained popularity worldwide. And by 2008, the worldwide hedge fund industry held $1.93 trillion United States dollars in assets under management. However, the financial crisis of 2007-2008 caused many hedge funds to restrict investor withdrawals, and their popularity and ARM totals declined. ARM totals rebounded and in April 2011 were estimated at almost $2 trillion.